HTMH 830 and emerging markets are continuing to trade sideways to down. The trend that has seen developed markets receive a majority of the flows as investors have been at least looking to the growth and what seems like now a Goldilocks situation in DM. I would just say be very careful. Evidence of the recovery is definitely pushing developed bond market yields much higher. That's pushed equities higher, but ultimately a normalization of interest rates has to come about, and equities will be less able to ignore the higher rates. I think when you look at emerging, and it's been very clear, we've made it clear that emerging has suffered in this environment because their rates have already started to go up and people have priced that in, and I think that's really the point. Developed is much more rate sensitive and actually could end up falling significantly under the weight of higher rates, whereas EM has seen this. So I don't know that there's a change in this sentiment and this flow in assets over the next couple days, let alone week, but I would just say that more good news out of the U.S. and interest rate expectations are going to rise, already have, and the total amount of debt, which is very much the same burden it was a year ago, is going to hurt. So take a look at the places where value exists. In EM, significant value has been created. I would also point out that the premium for PEs in the growth part of the EM space, that's typically consumer, that's typically technology, is actually narrowed significantly to the value portion. So it may be a place to actually be buying growth again. Some of the consumer names are down 25%, especially some of the hot names in Brazil, some of the hot names in Russia. But if you really want to see the pain, look at Turkey, look at India, and look at South Africa. Those are places where I think you've got significant opportunities. In Turkey, you're beginning the earnings season for banks. Garanti is the class of the operation, and I think their outlook is going to be more important than the fourth quarter. NIM compression is something markets are very concerned about, whereas we think the ability for these guys to hold on to their margins is actually much better than the market expects. So I think that's the tone and the theme of the day. The macro globally remains somewhat light, although Bernanke's out there speaking, and there's a big speech tomorrow also in front of the House. Those will all be places to gauge the move in rates in some sense where markets are taking things right now. Where is the Fed? Yet again, it should not be a surprise to people to hear that the Fed is sidelined. You're going to need 3, 4, 5 months of significant labor growth to take the Fed off their mark here. So those are all your backdrops. It's a reason why the weakening dollar trend should continue. The playbook of yesteryear is something that I think you can continue to stay close to, which is continue to follow some of the energy path higher. That remains. That includes also some of your solar names, your uranium names, your precious metals names. I think can continue to run in this environment, but global markets to me look very stretched. Emerging, I wouldn't call it oversold, but it's starting to look very interesting again, and if you're a value investor, this is exactly what you're looking for. Thanks.